I think that where people get caught is that they are trying to have this long-term investing mindset when they're broke.
Yeah, dude. Then you're going to be buff.
I will say the home gym is 100% one of the best investments I've ever made.
It is nice.
It saves so much time.
Yep.
Right. It's so easy. And then like I have it outfitted where I can have literally anything in there, except for like some of the weird specialty equipment you see in like a big gym. But I have like a full cable machine.
Yeah.
Barbell plates up to 500 pounds.
Squat rack, kettlebells,
yeah,
rower.
I got a box. I got an incline thing so I can do, GHDs or back extensions, whatever. Got a treadmill. Got everything. Got tons in it. And it's the extended bay so I can do like carries and stuff in there too. It's awesome.
The only downside to a home gym, because there's a lot of upsides, the only downside that I find is that you miss out a little bit on the social experiment of going to a gym, which in a lot of senses is awesome.
It's just people watching at my gym.
But I mean, in a lot of senses is great. But if you have like a community style gym where it's like more of like friends and stuff like that, you kind of miss that. But that's the only downside.
You just find it somewhere else. That's why I got into pickleball.
The bar. But yeah, I like the home gym.
What's going on, guys? Welcome to the Collecting Keys Real Estate Podcast. I'm Mike DeHaan here with my co-hosts Dan Austin and Dylan Cook. And just to round out that little pre-show comment, I will say a bad place to socialize and meet people based off of what we've been seeing recently is your local real estate meetups. Because boy, everyone that's doing deals stopped going to those like years ago. And the only people that are left are either the like newbies who probably aren't going to do anything and they can't figure out how to make real connections, or the people that are trying to scam newbies by selling them stupid ass deals like this one
snakes
that we rejected yesterday in our lending company.
Hold on, I want you to tell your story, but as a quick sidebar, Pace was in Cincinnati like a week ago, and I really wanted to go just to shit and ask like the hard questions, but I couldn't make the time work. And I'm not driving 40 minutes to come do this. But
dude, and then you'd have to like go and like be in that room with all those smug people.
I think I would have got beaten because he like has a huge like. Some people love him.
Yeah, he's got a cult following, dude, and people do really like him.
I know.
Yeah, that perch at the stake.
Yeah. Oh, dude, you would for sure. That'd be like going to like a pink hair rally in like a red hat. You're gonna get beat up.
It takes 15 of them.
It's a limp wrist beat up though, right? Like it's not going to hurt that bad, but you're still going to be really traumatized by it.
Sorry. Go on with your scamming turnkey provider that I know you're going to tell us about.
Yeah. So this is one in our lending company we rejected yesterday, and I wanted to bring this up on the show because it was so just asinine, like the way that this whole thing played out. And so lead comes in, it's in Indianapolis, and the seller is a company based out of Florida. That's fine. Whatever.
Great market experience.
Great market experience for sure. The funny thing is the buyer's actually like a local guy. He's in the area. So you think that he would know. So he's buying this property for $375,000. Cash flow super high. It's Section 8 property. And so basically they're getting over market rents, whatever. So we go through it and we get the appraisal back. And the appraisal comes in at like $240,000, like significantly below. And the buyer calls. He's really upset at how bad the appraisal was. And then so we started like digging into it and I was like, no, I think this appraisal is actually like pretty spot on. You're just overpaying for the house. And the guy said that he knows he's overpaying for it, but the seller, and again, this is a new investor, this is his first deal. So the buyer's pissed and he comes back and basically says, no, the seller said that it's a good deal because the cap rate basically justifies this $375,000 purchase.
The story gets me so mad every time.
And we're like, that's not how residential real estate works. It doesn't go off cap rates. It goes off of market appraisals. He's all upset. The seller calls us and is now going after us about how we don't know shit about real estate. And if you look at it from a cap rate perspective, with all the Section 8 tenants they put in there, it's actually a really good deal. And we just don't understand how to determine real estate values. And we're wrong as...
Or the appraiser. Apparently the appraiser doesn't understand too.
Or the appraiser. And so Chance had to explain to him like, hey, look, it's not us that's valuing, it's a third-party appraiser. That's how lenders work. And the guy's like just beside himself.
Doesn't get it.
So anyway, where this ultimately ends up going is the buyer decides that, oh, well, I'm just going to buy it on seller financing instead. And he says that basically the appraiser has rung the alarm bell. The lender has rung the alarm bell. The whole situation is kind of sketchy. He's a newbie, so he should be skeptical in general, but he's so convinced this deal is good that he's not trying to buy it seller financing. And if you look at the trail on this thing, this company, the sellers, they bought this property for $70,000 like 2 years ago.
There's so many red flags.
Oh my God.
And we were looking at like the photos and this dude's like renting closets to Section 8 people for $100 a month.
Here's what I don't understand on this. And this is where the red flag first got raised when the idea was, well, it's Section 8, so cash flow is like a beast. Section 8 is based on market rents and they have pretty strict rules. So my question is what is falsified within those leases?
Exactly.
Because Section 8, you have to inspect that shit. Like you can't just get Section 8 rents. Like they want an annual inspection. They run the market analysis. Like everything's based on like pretty strict policies.
Well, you can pull stuff over on the city, right? I mean, we had a whole 7-unit property where one of the tenants did that, where she pretended to be the landlord and she had 6 faked leases and she was collecting COVID relief money.
They could call it a 12-unit apartment building, but really it's a house, right? You could totally do that. And just that's where I'm like, that's a red flag immediately. The second red flag, you should, as a buyer, when the seller's like, don't worry, I will sell or finance it. Because if it was such a great deal, they'd be like, cool, get bent. I will find somebody else that will buy this because it's such a good deal.
But the thing that's so crazy to me is you have this new person who met this company, by the way, at a meetup. That's what he told us. I guess these people regularly do this. And the actual name of their company is like Easy Cash Flow Indianapolis, LLC. Right. So it's obviously some like turnkey company that just like peddles up these shitty Section 8 properties and then sells them to idiots. And he's so adamant that he's like right. And he's found like this super creative, cool thing to make this property worth it to him. And everyone that's been along the way, that's further along the industry, is wrong because he thinks that he's discovered some secret sauce.
Hell yeah.
If that doesn't define the real estate industry right now, I don't know what does. Everyone seems to think that they have like this super secret thing that is only completed at the detriment of somebody else, whether that's the buyer, whether that's the tenants, whether that's the community around your property because you're doing co-living and you have 9 people in a house with 9 cars and 9 different family dynamics, right? In like a cul-de-sac surrounded by normal people.
So silly.
Which is another one. As on our local neighborhood page, I sent this to Dan on Monday. Somebody posted that somebody had just bought the house next to them and was converting the garage into 3 8-foot by 8-foot bedrooms.
Oh, shut up.
And they found out that he was going to be just putting a bunch of people in there.
Refugees, wasn't it?
Well, yeah, that's what the guy said. I don't know.
I thought that was the actual thing.
No, that might have just been his politics coming out there that he thinks that if they're 8-foot by 8-foot, it must be refugees going in there.
Well, yeah, it might be prison camps.
It might be. But, and he pointed out, he's like, so that means the entire cul-de-sac can be full of their cars. Like, what are these people going to do? Is there going to be traffic coming and going? How do we understand who's actually supposed to be at the house if these rental by the rooms are changing all the time? Like, how can my kids have any sort of security walking around when there's like new people that are swapping in and out of the rooms, like monthly, like every quarter? What is that going to look like? And there's so many valid questions. And now it is reducing the lifestyle and the value of that neighborhood for this one person to try and squeeze more cash flow out of a house. It's a stupid thing to happen.
So they can make $300 a month instead of $200.
Seriously, right? What are they going to make on it? A couple grand? Good for them. I don't know, dude. It's just the way things are is so frustrating.
What's worse is they'll try to end up selling that place on a cap rate basis to somebody else because of the income.
Of course. Dude.
Oh, yeah. And somebody will listen to that, dude.
Yeah.
I know.
Yeah.
We need to have a new segment. Can we call it like Bad Deal of the Week or Dummy of the Week or something like that? Because I think Dummy of the Week is, I'm going to pull his name up and announce it on the podcast here. We can send you a t-shirt.
Jim Richardson, Indianapolis.
Yeah. We're going to send you a t-shirt for the Collecting Keys podcast Dummy of the Week.
Well, what's great is we could do that because from the land stuff, we have his address. We could just have make like a Dummy of the Week shirt, Collecting Keys with like an arrow pointing up to his head.
Oh, that's hilarious.
He just like cold gets it.
But then on the back of the shirt, it just says it's the denial letter, like loan denial letter printed out on the back. Like, that's how we send you the denial letter.
Yeah, that's a good idea. Yeah, your loan's been rejected. That's a great idea, actually.
Now, I'm going to play devil's advocate for just a minute. And I want to hear your response to that. Now that you guys are lenders in your Patagonia vests.
I literally just bought a bunch of them for us.
I bet you did.
He did. Yeah. We're so excited. We're so excited.
I bought puffies. They're Carhartts though, because they got to be more, a little bit.
We're from the Pacific Northwest.
More Spokane.
You're already too smug. Anyway. Yeah. DSCR lenders, at least how it was used to be pitched, was no appraisals, no income. I could be a cactus plant and get a loan as long as my DSCR was over 1.25. Did that ever exist? And I know, what does it look like now?
So I personally have never been around the no appraisals DSCR because even when I got my first DSCR loan in 2018, they still required an appraisal. So I don't know about that. But the lower dock no income as long as positive. It definitely used to be easier.
I feel like they definitely have tightened up, just like how they review stuff, like the liquidity requirements and things like that they're requesting. They're requesting a lot of the same information, but they're wanting like factual things to back that up instead of you just saying, oh, it's good, or you submitting a document and them saying it's good. They're like, that document looks like you made it on your computer. Can you sign it at least?
Yeah. I will say that, I mean, the tightening of it is as a result of all the fraud that's occurred over the years. It's just like anything. If you have a debt product that is too easy to get, people will take advantage of it.
The biggest differences that I see now too is like there's still no like what people like the income, like there's no income requirements from a personal income standpoint, and there's no disclosures and all the other BS you have to do with like Fannie Freddie loans. So it is still a lot simpler process, but it's like the big difference I tell people is just like, it's like you don't have to submit your W-2s, and the income is solely based on the property still.
You're not submitting tax returns. You're not submitting W-2s. Maybe not bank statements.
It's still the property. That's still asset based.
Yeah. And you technically can get properties that are negative DSCR as well. I mean, we did one last month.
I mean, that shouldn't exist in my opinion, but like, I get it. Yeah.
I also think so.
We're doing one on Friday. It's like a 0.92 doing tomorrow.
What's the lender's justification for that though? They literally are saying this barely supports or doesn't support your loan payment.
Well, so think about it this way, as a lender, like you're devil's advocate here. And so as a lender, say you're doing it at 75% LTV, and say you have 10 properties that all cash flow. This is your 11th one, but you're getting it with some pretty fat equity. And as a lender, you're protected by the equity.
Basically, you're saying the equity or the personal balance sheet of the signer, you're okay with.
Correct. They look at that. Yeah. So there's like a lot more scrutiny on that if you're a newbie. For example, we've done only one negative DSCR. They're not super common. People don't want that. Another one coming tomorrow. Both of those people, they have like huge balance sheets, right? They own dozens of properties. They have high incomes in general. They send their bank statement. They have like $900,000 in there, right? Like they're not going to be worried if you're negative cash flow $200.
Sure.
There is more scrutiny. I would say the one thing that has been coming up, which has been interesting, is they will want a verification of housing, because one of the biggest pieces of fraud, like the types of fraud that has occurred with DSCRs, is people getting DSCR loans and moving into the property, right? I mean, it's very easy to do. You get it, and then no one checks. So you can move into the house whenever you want, right? And so now what they will do, and they're very, very strict about, is they need to know where you're living and know that you have like a history there. That didn't used to exist if you go back several years ago, but they've been really, really hard on that right now. I think especially as interest rates have gone up on the Fannie Freddie side and it's hard for people to qualify, people that are somewhat savvy will be like, oh, I can go and get a DSCR loan to buy this vacation home in Cape Cod or whatever.
Oh, yeah, sure.
And they're like, yeah, it's going to be a rental, but really they're going to move their family in there the second that it closes.
Yeah, that makes sense.
And so they really want to make sure that you have a primary mortgage either on your credit. If you're a renter, they want to see like a history of your rents being paid on time, once your lease, all that kind of stuff. But you still could wait like a year and then fucking move in.
Yeah.
But they're at least like checking it now up front. Whereas before they used to be super, super lenient with that.
I remember I was flipping a house in a good part of town, and my wife and I talked about moving into it, but I already had like the hard money loan. And I remember, well, this is going to be a problem if I go to refinance, because it's not an arm length transaction, from my own LLC to our primary residence. And so we ended up not doing it, not for that reason, just it was different at the time, but like
it could be hard to get the loan at the size that you need it to be, right? Because it's not an arm's length.
Right. Yeah. Because what if I wanted a 95% loan, LTV on a primary, right? It'd be just different. Speaking of another newbie though, like I talked to a guy this morning, and if you're listening and you're kind of new, don't do this. But his first renovation is a $200,000 renovation.
Just crazy.
Yeah.
Dude, like you might as well rebuild the entire house.
If you're doing anything above 100 is crazy.
Just over 2,000 square feet. Plus they redid the garage. So there's, kind of two structures, but it was everything. It was framing, plumbing, the whole 9 yards.
You could build a house for that much.
Yeah.
You literally could. I mean, think about what they paid for the house, which you could just chalk that up to the cost of the lot, which I'm sure lots are cheaper in Ohio than 190 plus 200K. You could literally build a brand new house. It wouldn't have character, of course, or illegal wiring, but
it doesn't have illegal wiring anymore. I guess my point being is like, if you are newer, I would never have envisioned if I was new to take on a renovation that big.
No. Oh my gosh, no. It's a bad deal. Don't do that.
I don't know where the rose-colored glasses are. I don't know where that's coming from. Like, it'll be, make this amount of money. Like, where the verification steps are before you pull a trigger on something like that.
So they bought this from a local wholesaler?
Yes. Yeah. One of my biggest competitors.
That probably told him it was a good deal.
Well, yeah, I mean, of course they did.
Really? And they told him it was a great deal. And he made 40 grand on it.
I think he only made 20 only, but 20.
But still on a $140,000 purchase, that's pretty good. I think that where people kind of get sucked into that is there's a lot of people that get into flipping houses because they have like this vision about how they want to like take something that's terrible and make it really nice again. That's also why you see this symptom of people that are buying like lipstick sort of flips and then like really overdoing them and then losing money. It's because like that's what they feel like house flipping is, which I think is a good purpose, right? Like a good like selfless motivator if you're somebody that feels like you want to lose money and make the town prettier. But at the same time, it's not a valid way to go around actually building a business with it. And especially in somewhere like Cincinnati, where there's a decent number of houses relatively affordable. So people have options. Like I think that where people tend to be able to do that a little bit better is if they're in like a very high price point market.
Yeah.
Right. And there actually is like a demand for that older style of house that's done at like a very, very high level, but you also have the profit margins to do it. So like there's James Daynard, he does this in Seattle, in Scottsdale, where like, yeah, they take the house that is kind of 2,000 square feet and they put 300 grand into it, but now the thing's worth 1.2.
Totally.
Yeah.
Like absolutely. That makes sense.
There's huge margins. Yeah.
And like your little details in that design matter. No offense to Cincy, but I'm pretty sure the Cincy vibe's a little different in Scottsdale, right? I've never been. I'm just assuming.
No, I've been to Scottsdale, so no like rebuttal here.
I think this goes on to the same, like along the lines of with like, especially if you're a newbie, but just in general, like this goes for everybody. If a deal's complicated, we reviewed one this morning in our team meeting, going over some loans and stuff like that. And you just get some of these guys that come in with these like complicated plans. And in my opinion, if you can't show the ROI with like 3 lines on the back of a napkin, you shouldn't do the deal because they want to do all these weird things. I mean, this goes along the lines of like all the subject to stuff that we've always talked about. But you get these deals where guys are like, I'm going to do this, and then I'm going to build a house on it, and I'm going to do this. Like, no, you're not, because you don't understand like how hard that is and how hard it is to get the funding to do that and do all these like land splits and do all these like really complicated things when they don't even just zoom out for a second and look at the most simple things like, oh, you have acreage in the middle of everybody else having acreage and all your neighbors are white trash, trailer, junked out houses, right? Like, so who's going to want to buy a brand new house in that? Probably nobody. That you have to drive through your other driveway to get through. There's so many other options out there. Like, so don't overcomplicate a deal. Like, that's not a deal. And then they'll look at the numbers, they'll do all the math, and they'll say, if it all lines up, this is how much I'll make. And this is a great deal. And you're like, cool. Now put in the risk factor, weight it for risk. And actually, when you do that the right way, you're probably losing money every single scenario you run it on.
For sure. I think that's the big thing, Dan, is people don't measure that downside accurately. Because ultimately, to get rich in anything, it should be about having asymmetrical reward for the risk that you're taking.
Totally.
Right? Like the reason people pursue tech businesses, as an example, is they're expensive to build out, but the overhead's like relatively low once it's going. But the multiples and the lifetime value you can get of your clients is extremely high. And so it's worth it for somebody to spend $15 million to build a startup because it could ultimately be worth 300, 400 million, right? When it comes to real estate, it's a slightly different scale. And you got to come down to like, well, if you can do a simple deal and make 40 grand, but your downside risk is maybe the down payment, say like $100,000, right? Major. Or you're going to go and you're going to bet 300 grand where you're hopefully going to make 100,000.
Doesn't make sense.
Right? You're going to make like maybe 2.5 times more, but there's so much more downside risk. There's so much more complexity. It just doesn't make sense to people. This is one of the things that it's funny. I felt like this kind of went away for like a little while. But I remember back in the day, Dan, where there was all these guys that would be like, I don't even do a deal if I don't make $25,000.
Right. Yeah.
And then it kind of went away. And like we sort of snuck by just hitting base hits all the time. And then the 9 deals that they would pass on waiting for their $25,000 or their $40,000 flip, right? We'd make $90,000, $100,000 in the little deals up through them. It's okay to take those easy wins. But for some reason, people don't want to. I think they think that success has to be an overconfident thing. That's true.
Well, they're desperate to do a deal too. I think there's desperation, and especially in a market like this where deals are hard to come by, and they see dudes like Dylan over here doing deals, the guys that are well established.
Yeah.
And I just want to do a deal. And then there's those snakes that go to these meetups that also want to do a deal, and they want to find the guy that's more desperate than them to do the deal so they can make money on them.
For sure.
And you get these weird math equations that aren't ever, like I said, they're never weighted for risk. And then you need to weight it for your financial position now, because ultimately flipping a house, I would still consider it, although it's an active income, I would still consider it real estate investing, because you are buying an asset that may or may not need to be held for a period of time, which at minimum 4 months, probably, maybe 6 months, 8 months, maybe a year, maybe longer, depending on what happens on the backside. So you are still investing. And so would you take 100% of your net worth and put it in Bitcoin? Maybe not. Most people wouldn't, you know what I mean? But if you're doing that, you're going risk on. Same thing with flipping a house.
I think as I, go down the wealth building journey, and the people that are, way richer than me, they always value cash more than a lot of like newbie people do. Having all their eggs in one basket and being like in a
such a good
liquid thing like real estate. Like if all of it's in a flip and something goes wrong, you're kind of screwed, right? But like a lot of the wealthy people I know, I mean, they're up to 30% in cash. And if you have $10 million, that's a lot of money.
You can do things with it.
Because cash gives you the ability to capture opportunity.
Exactly.
And I think that if you don't consider having a good cash position, like you don't try to do that, it's a very immature way to look at wealth generation, right? Or being an investor. We actually had a good conversation with Drew yesterday or Tuesday on our scale call about this, because he's such a big buy and hold guy. Drew Wired, you guys have heard him on the show a couple of times.
Friend of the show.
Yeah, he's a really big like buy and hold equity guy. And we just did a big cash out refinance with him, and he pulled out, recaptured a lot of equity. And it's something that was so interesting to me is he said, he's like, but the way I see that is that I just like cashed in that equity. I squandered it. And I was like, no, you gave yourself an opportunity to make more of it with that money now.
Yeah.
But they're just completely different mindsets. I'm not saying at all that Drew's an immature person. He's much wiser than I am. But there's also these different mindsets that people have around being an active investor versus being somebody that is truly investing for like the long term. I think that where people get caught is that they are trying to have this long-term investing mindset when they're broke. Right? Or they don't have a high income.
That was good.
Yeah.
That should be the headline in this one.
Yeah.
That was good.
Like get some cash first, man.
Totally, dude. And I mean, even right now we have this borrower that we've been working with. He's a super nice guy, but he's trying to buy all these rentals and he literally has no money. I'm like, dude, go like make your money first and then come back and focus on that. Or it doesn't make any sense.
Or sell one or two of the rentals, then get your money, then go do it.
100%. So people approach things a different way. And then, in terms of your guy with the $200,000 renovations, the opportunity cost there too. So he's put all that money in there. What if, so he's a newbie, what if he'd taken that $200,000 and invested it into marketing, invested into learning to find his own deals? Right? He could have gone incredibly far. He could have gone and paid for the most expensive wholesaling one-on-one mastermind coach out there that probably would have stolen his money. But even if they didn't, he might have learned how to make a hell of a lot more than even that one flip could have ever made him.
Even from the lending side, like cash flow would have killed it. Like,
totally.
I see what my hard money lenders make sometimes, and like they make more than I do in some of the flips. I'm just like, you didn't do jack shit besides collect the interest.
We sent out a payoff this morning that I think we're making like 35 on it, and the guy's making like $6,000. It's great.
Yeah, right. It happens. I mean, it happens though. It happens a lot. So November is actually like transparently was like my worst month in business pretty much since I started.
Oh, that's fun.
Yeah, I mean. It is what it is, but we sold a flip that I lost about 40 grand on, and the lender made like almost 30.
Nice.
That's a great deal for the lender.
Yeah.
And because you're a great borrower.
Yeah.
Yeah, right. He had no risk of default.
Is that your biggest loss to date?
By far.
Oh yeah. Well, that's pretty good. I mean, to have gotten this far and finally getting like that, what really kind of hurts loss, that's pretty good.
That's what Dylan and I were talking about pre-show before you got on, Mike, was like, you're going to lose. In any game you play, if you play, it's law of averages. But for Dylan to lose now is way better than losing in the beginning. I think this actually is a good full circle argument here for these newbies trying to do these complicated deals. Is like, you don't want to lose early on when you're broke, because you actually do have further to fall. It hurts more because you could go into bankruptcy. So when you're doing a high leverage deal, you're not actually like tying up all your cash. You're actually going negative net worth. Right. So if you have a zero net worth and you go get a hard money loan and you go get a second position for the down payment, and then you have to get the construction costs and all that, you're actually going negative net worth. Where Dylan is obviously well established. So for him to take this loss, it hurts. It sucks. Nobody wants that. But if it's inevitable, you definitely want it to be once you're established. And so you have to do those base hits. You have to put all the time and effort into doing the right deals that are risk weighted so that when you do take the loss, it's not going to kick your ass and put you out of business.
Totally. Yeah. So I guess on that note, Dylan, so looking at this deal, let's say if you were from like a newbie perspective, right? Is this a deal that you would have done as a newbie? Is it something that you like tried to get cute with? Is it bad market timing? Like what's the actual full situation?
Yeah. I mean, it was a combination of three things. I guess one, the market did turn a little bit. We owned it for like 8 months. And so I tried a new contractor, didn't work out. We redo a lot of his stuff, which was extra cost. So we thought we were going to spend like 315 and we ended up like 285. So that was a big part. And then the buyer ended up doing a sewer inspection and the sewer line was all fucked. And I was to the point where I was the motivated seller. I was like, I'll just fix it, just sell it and get on. So that was another like 10 grand of replacing the sewer line. So it was just a combination of things. I never actually looked at the property either. When the first deal, my acquisition guy walked and I kind of trusted that would be right. And I was like, I've done enough of these. I know the area, like it'll be fine. So I don't know if that answers your question. It's a multitude of factors, but they all kind of added up.
Yeah, for sure. So a little bit of bad luck, a little bit of poor due diligence, a little bit of like stretched time, which happens as a business owner. And this is something that I don't think people realize as well is, so one of the questions I get asked a lot, or have been asked a lot over the years, is around having your acquisition managers make their own offers. People will say like, I need them to be good at real estate so they can make offers. I don't want to have to review deals. We learned this lesson a long time ago, but when we were running our wholesaling business, we would always make sure that we were the ones that were approving the final offer. Just because at the end of the day, your nuts are on the line, right? You're the one that actually had to go and take that loss for their decision, because people don't understand that the downside loss you can have from an employee that is underperforming or that is making a bad decision is significantly more than the upside potential of that employee, especially in a levered business like real estate, right? And so going back to when Dan and we had our biggest loss on a house flip. This was back in, was that 22, Dan? 19th deal?
Yeah, it's probably ended January 23 is when it finally came to a close.
Yeah. So basically on that deal, everything from how the acquisition manager priced it out to how the project management kind of went on the getting the tenants out and all this sort of stuff. We had somebody that was our dispo manager that was basically helping with that. And he botched a bunch of things with the paperwork. He also rubbed the tenant the wrong way. So they became resistant to working with us. So that added like 6 months to it. To then, we got away from that person. We realized that a lot of the little details that we were expecting around the renovation weren't actually correct, because the notes that we had gotten from the team members that we trusted to do the walkthroughs and everything were not accurate. Right. And that ended up costing us over $100,000.
Yeah, that's a nightmare.
Over these couple of decisions that our team members that were under our guidance, right? They were just inexperienced, ignorant, negligent, whatever you want to call it. But we were so busy trying to do all these other deals that we were just like, oh, we already got that one. Yeah, we'll figure it out. And then the market turned into a whole mess.
Yeah. A lot of those mistakes don't happen, but then when there's the market, or you don't feel them, but if there is a market shift, those mistakes actually get really painful and the cuts are just deeper.
They get amplified too.
They get amplified.
Yeah. At that point, it was really dangerous as well, because we had just come out of the market cycle where you were saved on every deal by the market conditions. And so that was kind of our bring back to reality.
It was.
The one thing that happened that, it's happened before, but it's not spoken about a lot tactically, is a lot of the comps we used when I bought it. Well, this flip took 8 months. So a lot of the comps I used were no longer really applicable to anything. And the new ones were much lower. I'm like, well, fuck. So even if I refi this, I'm not doing great. So,
and your deal might be the new comp too, right? So like an appraiser might use a few of the comps from 6 months ago, not 8 months ago, but maybe 6 months ago. But the reality is the market is 8 months fast forward. And so you may be the guy who's bringing the market down 10% with your new comp. Yeah. It just happens, right? In this market, you know what I mean?
Yeah.
Yeah. I mean, and right now, more than ever, if your stuff isn't selling, it's because it's not priced low enough. If you price it low enough, it'll sell.
That's 100% what it is. Yeah. It just sucks.
On our last flip that should be closing next week, it's out on the market for months at like $350. Then we were at $340.
I think we started out at $365 is actually where we thought we were going to hit.
Yeah. Right? I don't think we were that high. I think it was like, did we start at that high? That one? Oh, damn.
Maybe $359 as we ultimately did. And then we did some price drops down to $350 and sat there for a month.
Forever. And our other partner was like, no way, man, this thing's totally worth $370. I'm like, I don't think it is, dude. No one's buying it. So we finally dropped it to $335, sold literally the next day. right away.
Yeah. That's the thing, man. Things are so price sensitive right now. And a lot of sellers, I wouldn't say flippers, but like retail people are refusing to price drop. So I'll take it off the market.
I know. Yeah, it sucks. It sucks because that fake equity, you can't eat equity, as they say, because it's not real. Like that fake equity still sticks with people in their minds and they want that number.
But you can refinance it out. And you should do that before the appraisals drop down too far to reduce your value. You want to refinance while they're still using the appraisals from 6 months ago that aren't down to
slacapital.com/apply.
There you go.
No, I got a referral code.
Right to it. Yeah, you do.
Use Dylan's referral code. Hit up Dylan. He gets paid out.
If you go through the slacapital.com/apply and you specifically tell our loan officer that you're calling us because Dylan said to on the show, I'll give you Dylan's discount.
There you go. Dylan's discount.
Yeah.
It's going to be Dylan Does Cincinnati as the discount code.
It's the promo code.
Is that like the gay version of Debbie Does Dallas?
Yeah. Well, isn't his handle like Dylan Does Deals? So now it's just Dylan Does Cincinnati. And next it's going to be Dylan Does Loans because he's going to be richer than all of us and just start lending out all of his money.
I see what you guys are doing. I'd like to start doing loans too.
You should.
What's funny is I have, a portfolio and I've done the math. I was like, I could leverage my portfolio and borrow at like 6-7%. And if I can lend it out at 12 and 2 to people I know in my market, like that's not bad money.
It's good money.
This is the arc that all real estate people go through, right? As you get kind of sick of buying properties, start to build this equity, and you're like, man, I'm buying another fucking duplex with toilet problems and shit. Or I could just take the money I already have and leverage it and increase my cash flow that way. That sounds way better. It's like, oh, and it's actually passive income once it's in there.
It's the real estate wealth arc, man.
Totally. Pretty much everyone that I've met that's like a smaller lender, like the really big lenders are all finance guys. Like a lot of the guys that we sell our stuff to, like they've never touched a house. They're going to get their little prissy fingernails dirty if they do that.
They don't even work on their own houses. Yeah.
No way, dude. They never have.
They do have Patagonia vests though.
They do. A lot of Patagonia vests.
You guys are going to be like, there's going to be a picture of you in 2016, and then pictures of you guys in 2027. Just the difference of these two people.
So different.
It's going to be our Christmas card, man. We're going to have like this super like sharp beards. We should both get those surgeries that make our cheekbones real high.
High cheekbones, sharp chiseled jawlines.
Yeah, exactly. Vests. Like total. And we're changing our name to Jabroni Capital.
There you go.
Yeah, I've actually stopped lifting weights because I don't want to have calluses on my hands anymore.
I stopped lifting weights because I want to be like razor thin so I can be really good at cycling and Ironmans.
Yes. High rocks. We're doing high rocks now.
I'm doing high rocks. Totally. No way, man. There's too much weightlifting in that for me. I don't think there's any at all.
Running.
Take the Christmas card picture with an IPA and then they'll be complete.
Nah, they don't drink anymore. Instead, what they drink is they'll have like some kind of like seltzer water that has THC in it. Yeah. Right.
Yeah. It's seltzer water, plain water because they're healthy, but then they do cocaine all night.
Yeah. Maybe. I think it's one of the cool ones. I think most of them they're doing like ayahuasca in Utah somewhere. Not even going to like Peru and doing it the cool way.
Yeah. No. They're going to San Diego and getting some psilocybin.
God, out in the San Diego desert. Sounds like fun. But anyways, well, we went all over the place. Anything else to wrap up here, guys?
No. I can see from Dylan's watch it's cloudy in Cincinnati, though.
Yeah, it is.
There we go.
And you got a few text messages that came in.
I got 25 right now. So
got 25. All right. We're going to let Dylan go and do his deals then. All right, guys. Thanks for listening. We'll talk to you guys next week.
See y'all.
See ya.
This episode is sponsored by Sir Lancelot LLC, also known as SLA Capital, which, if you didn't know, is Dan and I's private lending company. So yes, we are sponsoring our own show, but what you going to do about it? It is our private lending company that offers hard money and DSCR loans to real estate investors of all types. So you can be a new investor, an experienced investor. You can be buying flips. You can be buying rentals, whatever. We can do everything. And not only that, but the rates that we offer are just as competitive, if not cheaper, than pretty much every other company out there. So whatever big company you've been working with, bring us their term sheets and I guarantee you that we can probably beat it. We have the same connections they do. We just don't have all the overhead and middlemen. So if you want to come and check us out, go to slacapital.com/keys and I will know that you came from the show. And by seeing that you came from here, when you get to closing, you will save $500 on your first loan with us. So slacapital.com/keys, we would love to fund your next deal.
Thanks for listening, everyone. If you want more from us, you can shoot us a follow on Instagram. I am at Mike_invest. Dan is at InvestorMan Dan. And Dylan is at Dylan_does_deals. Shoot us a follow and send us a DM to let us know what you think of the show.